This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Tough talk. The president late today did not back down on his tariff threat, leaving the bulls on edge over the possibility of a global trade war. Thawing of tensions. Does the prospect for talks between North Korea and the U.S. remove one of the risks from the market? Missing the target. Shoppers flock to the retailer's website, but at a cost to the company. Those stories and more tonight on Nightly Business Report for Tuesday, March 6th. Good evening, everyone, and welcome. I'm Sue Herrera. Tyler Matheson is off tonight. Just when some investors thought maybe, just maybe, the tariffs proposed by the White House would end up being more targeted, the president late this afternoon said he had no choice but to follow through with levying steep tariffs on steel and aluminum.
When we're behind on every single country, trade wars aren't so bad. Do you understand what I mean by that? When we're down by 30 billion, 40 billion, 60 billion, 100 billion, the trade war hurts them, doesn't hurt us.
At that White House news conference with the Swedish Prime Minister, the president warned that he would impose a 25% penalty on European car imports if the bloc carried out a threat to retaliate. The possibility of a trade war sent stocks all over the place before the Dow Jones Industrial Average finally finished just 9 points higher to 24,884. The Nasdaq was up 41 and the S&P 500 added 7. Bob Pisani has more on the push and pull in this market.
More whipsaw action for the markets today. The Dow Jones Industrial Average swung between triple-digit gains and losses, higher by 166 points at its height, but essentially unchanged at the close. Traders have been hanging on every word out of the White House and other congressional leaders on the state of the proposed tariffs. Stocks rose briefly midday when Georgia Senator David Perdue suggested the president might be flexible on the tariffs. But in a late-day press conference with the Swedish Prime Minister, the president did not back down on his threat to slap tariffs on steel and aluminum imports, claiming that China sends much more steel to the United States than most people think. He disputed early reports that said that China imports only about 2% of the steel brought into the United States. Where will all this end? Bulls are praying for a 1-2 punch, that by the end of the week, President Trump will indeed sound more conciliatory on tariffs, and that Friday's February jobs report will show wage growth is subdued. Now remember, January's wage growth of 2.9% year over year was the strongest since 2009. That caused a 50-point drop in the S&P 500 a month ago and was the start of much of the chaos in February. If we get that 1-2 punch, the markets will definitely rally on Friday. Until then, the bulls are going to be on edge. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
House Speaker Paul Ryan pushed back against the idea of broad tariffs and said he's urging the president to take a more targeted approach so as not to have a negative impact on the economy.
What we're encouraging the administration to do is to focus on what is clearly a legitimate problem and to be more surgical in its approach so that we can go after the true abusers without creating any kind of unintended consequences or collateral damage.
The European Union is reportedly ready to play hardball. According to Bloomberg, officials are preparing punitive tariffs targeting roughly $3.5 billion worth of iconic U.S. brands that are produced in the states of congressional leaders. For example, the list of targeted goods includes motorcycles. Harley-Davidson is based in Speaker Ryan's home state of Wisconsin. Bourbon, made in Senate Majority Leader Mitch McConnell's state of Kentucky. And jeans. Levi Strauss is headquartered in House Minority Leader Nancy Pelosi's hometown of San Francisco. A new development tonight out of Washington. Economic advisor to the president, Gary Cohn, is resigning. It was first reported by the New York Times. Hampton Pearson is in Washington for us tonight. Hampton, what do we know?
Sue, National Economic Director Gary Cohn is leaving the White House. First, we have a statement from President Trump saying, quoting now, "Gary has been my chief economic advisor and did a superb job driving our agenda, helping to deliver historic tax cuts and reforms and unleashing the American economy once again." From White House Chief of Staff John Kelly, Gary has served his country with great distinction, dedicating his skill and leadership to grow the U.S. economy and pass historic tax reform. And from Gary Cohn himself, quoting now, "It has been an honor to serve my country and enact pro economic growth policies to benefit the American people, in particular, again, the historic passage of tax reform. Gary Cohn leaving the White House, we know that he had been on the opposite side of the president's desire to enact strong trade tariffs involving aluminum and steel, but the White House and White House officials saying it was not the only reason that got us to this point where Gary Cohn is now leaving and on his way out as National Economic Director for President Donald Trump.
All right, Hampton Pearson in Washington. Hampton, thank you very much. Bill Adams joins us now to talk about that and much more. He is the senior international economist with PNC Financial Group. Welcome, Bill. It's nice to have you here. This is a late development.
It's nice to be with you, Sue.
It's a late development being reported by the New York Times. And we should add that Mr. Cohn was pushing back very hard against the implementation of these tariffs. But given the talk from the president this afternoon, it appears that he has definitely lost that fight. What are the implications for the rest of the Trump economic agenda if Mr. Cohn is not there?
I think the immediate implications of implementing these metals tariffs would be the retaliation from the European Union and other trading partners. It's going to target U.S. Exporting industries. So I think that's going to be, if this does indeed go through, that would be a headwind to those targeted exporters, fewer export sales, reduced export profits, and fewer jobs servicing those exports than we would otherwise have seen.
Can I turn you to the New York Times report that Gary Cohn is apparently going to leave the White House? He is the one who basically championed tax reform, the tax reform plan. He's involved with the infrastructure plan. He pushed back against the tariffs. He's obviously lost that particular fight. How will this impact the economic agenda of the Trump administration if he is not an advisor to the president any longer?
Well, there are obviously multiple streams of thought within the administration about having more conventional economic policies versus more of a protectionist policy. I have been watching over the course of the last year plus to see which of those policies have been implemented. And there are still forces on both sides, both within the administration as well as within Congress.
All right, let's turn
so
to...
I'm still in wait and see.
Okay, you're in wait and see mode. I guess one of my questions in terms of trade specifically is whether this is just going to be a slight retaliation, if indeed it comes to that, by the EU, or whether or not we're going to be in a full-blown trade war like we saw in the 1930s and 40s.
I'm expecting in the base case that the EU will probably retaliate. If this happens again, they'll retaliate in a targeted way and in a limited way. That's what has happened between the United States and our trading partners in previous rounds of trade conflict. We have imposed tariffs on foreign imports in each of the prior two presidential administrations, so the EU knows what the pattern of U.S. policymaking is. The tail risk is a mutually escalating trade war, but I think that still is fairly unlikely because of the costs that it would impose on the U.S. economy.
On that note, Bill Adams with PNC Financial Group, thank you very much. Well, for one family-owned steel business, tariffs could mean a brighter future. Kayla Tausche is in Cincinnati.
Every minute at Buyer Steel, old railroad axles are fed into a furnace, heated to 2,400 degrees, and molded into 1,200 feet of steel rebar. Burke Buyer sells that rebar to commercial construction companies, but has had to drop the price to compete with cheap foreign imports.
We're over 16,000 miles away from Japan or Turkey, and I can buy Japanese or Turkish rebar at the Port of Cincinnati, 9 miles away, cheaper than my raw material costs. I don't understand how that works.
In the last 3 years, Buyer's profit margins have fallen nearly 40%. He says he's laid off nearly half the workforce at this northeastern Cincinnati mill. But Buyer says Trump's tariffs would reverse that trend.
We have production lines that are not operational right now. We are down from 180 employees to 95. those jobs can come back. We have capacity and machines right now that are waiting for a market to sell to, and there's people trying to work that want to come back.
Employment in Ohio's steel and iron industry has fallen in recent years, but its 15,000 jobs are a small portion of the state's labor force. Critics warn the downside could be much bigger.
There is a lot of concern among Republican senators that this could sort of metastasize into a larger trade war.
But Beyer says it's an industry worth protecting.
There's nothing you can do without steel. You can't get lipstick, you can't get soup, you can't get cars, you can't get all these things. You can't get computers. You have to have steel and commodities.
While President Trump's proposed tariffs would have far-reaching effects outside the U.S., they would give Burke Buyers' fourth-generation family business some posterity. For Nightly Business Report, I'm Kayla Tausche, Cincinnati.
The head of the Dallas Fed said tariffs on imported steel and aluminum have the potential to hurt trade relations with Canada and Mexico. He calls these two countries critical to U.S. competitiveness and jobs.
I'm concerned we're in the middle of a trade negotiation with both countries. This could have some chilling effect. But it's so clearly in the interest of the United States to have strong trading relationships with both those countries. I'd be optimistic about how this actually gets implemented.
Kaplan also said he favors 3 interest rate increases this year and that those should happen sooner rather than later. Many expect the central bank to raise rates when it meets later this month. Well, there may be signs of a thaw on the Korean peninsula. According to the South Korean delegation, the North is willing to hold talks with the U.S. about giving up its nuclear weapons. That helped send the South Korean ETF higher in trading today. David Riedel joins us now to discuss what possible talks between North Korea and the U.S. could mean for the stock market. He is the founder and president of Riedel Research Group. Good to see you. Thanks for joining us again, David.
You too, Sue.
Certainly a stunning and surprising development between North and South Korea and the United States. But we have seen hopeful signs before, and then they kind of fall to the wayside. How should the market react to this? Because that was one of the big risks that was in the market not so long ago, just a couple months ago.
That's exactly right. It was relatively recently that this was top of mind. I think it's been replaced in investors' minds in the U.S. with issues on trade and the impending trade war if we go that route, the number of Fed hikes in 2018 and so on and so forth. But it should not be downplayed. This is a very, very big deal. If we can get some level of peace and communication going on that's constructive in the South Korean peninsula, I think that's very positive for global markets.
So what do we look for? What would be another sign or the next sign, perhaps, that these talks might actually come to fruition?
Well, I think if you start hearing more noises about the U.S. participating in these talks, remember there was reporting that Vice President Pence was looking to meet with the North Koreans when he was in Seoul, and that got scrapped at the last minute during the Olympics. But if we start to see moves by the U.S. around this topic, I think that could be very important for solidifying the move towards talks and eventually perhaps a deal.
And what role will Beijing play, if at all, in either pushing these talks forward or perhaps even mediating parts of them?
Well, President Trump said today that he felt that the Chinese had been helpful, that Beijing had been helpful. I think if it shows that they have been helpful, some of our people on the ground in China have observed that there's been a lot less goods going across the North Korea-China border recently. There was a big effort in the UN by the U.S. to crimp North Korea's moves on shipping, and Beijing pushed hard against that. So if Beijing played a role in getting them to the table, I think that's very positive longer term, because with Beijing and South Korea both working on North Korea, moving them towards this, that can really make a big difference.
So you kind of touched on this earlier, but do you think the trade tariff issue and the possibility of retaliation has now superseded the worries that we had, or the fears that we had, of a conflict with North Korea, in the market's mind anyway?
I do. I think in the U.S. market it really has. As we saw, the South Korean ETF responded favorably. I would expect Asian markets to respond favorably tonight. But in the U.S. Investors' mind, I think they're more concerned about the growth trajectory and the interest rate trajectory here at home.
All right. On that note, David, always good to talk with you. Thank you so much.
Thank you, Sue.
David Riedel with the Riedel Research Group. It is time to take a look at some of today's upgrades and downgrades. UPS saw its rating raised to buy from hold at Stifel. The analyst calls it the most attractive dividend play among large-cap transportation stocks. The firm also calls the threat from Amazon overblown. Shares of UPS rose nearly 4% to 109.80. Mylan's rating was raised to overweight from equal weight at Morgan Stanley. This is the first time the analyst has increased his rating on Mylan in 3 years. The firm cites Mylan's drug pipeline and its growth prospects. The price target was raised to $50. Mylan closed up 4% to $43.23. Citi raised its rating on Herbalife to buy from neutral. The analyst cites the company's attractive valuation and sees a big rally in its shares now that activist investor Bill Ackman has exited his position. The new price target is $114. The shares rose more than 2% to $96.84. Still ahead tonight, Target. It's making some very big investments, but its investors are still looking for the big payoff. CVS Health plans to issue more than $40 billion of new debt to fund its acquisition of Aetna. It will be the largest corporate bond sale in more than 2 years, and it's also being looked at as a bellwether for the health of the corporate bond market. Target is spending a lot of money to remake itself, but it's coming at a cost. The discount retailer missed earnings estimates and issued a disappointing outlook, and that sent the shares of Target down more than 4%. Courtney Reagan spoke with Target's CEO about what's going on at the company and its future.
Target's holiday quarter turned out the strongest sales in 3 years. Online sales grew nearly 30%, and in-store sales increased after falling last year. But there was a problem. Costs for the discount retailer rose a lot. Employee wages and a big investment in its stores cut into profit. Target's outlook was also disappointing because all that spending will continue. Target executives met with investors here in Minneapolis near its headquarters as it begins year 2 of a 3-year, $7 billion strategy to grow.
We're going to continue to invest to grow. We're going to continue to invest in new capabilities to make sure we meet the needs of the guest.
The big box retailer now plans to accelerate its store remodel program and build out of smaller stores in bigger cities. It's also redesigning stores to better fill online orders and wants to give shoppers several options for getting their online orders faster. The retailer is expanding its network of personal shoppers in its new Shipt business and adding its drive-up order pickup program from nearly 50 stores to more than 1,000 by the end of the year. While investors want to see online sales grow, there is concern about the hit to profitability. But CEO Brian Cornell is confident his strategy will work.
So we're off to a good start. We're on a trajectory for positive growth, both in-store and online. Our new initiatives are being well received. So I think we're going to continue the progress that we made in 2017 throughout 2018.
Shareholders want Target to invest in its business as long as it brings a return in the not-so-distant future. For Nightly Business Report, I'm Courtney Reagan in Minneapolis, Minnesota.
United Healthcare is lowering drug costs for millions of its members, and that is where we begin tonight's Market Focus. Beginning next year, United Healthcare said it would begin passing down the discounts that it receives from drug makers directly to some of its members in the form of rebates for prescription drugs. The new policy applies to more than 7 million people covered by certain employer-sponsored plans, but it leaves out about 18 million members who are self-insured. The shares were off nearly 1% to 226.18. Ciena, which makes networking technology, reported a smaller than expected loss and revenue that topped expectations. That company said results were helped by growing demand for streaming services and mobile apps. Shares of Ciena climbed 10% to $25.71. BlackBerry is suing Facebook, claiming the social media giant infringed on its messaging app patents. BlackBerry said Facebook and its WhatsApp and Instagram units use technology and features that were present in BlackBerry's first smartphones. Facebook shares were off a fraction to $179.78, and shares of BlackBerry rose slightly to $12.44. And after the bell, tax preparer H&R Block reported results that topped expectations. That company said promotions helped to bring in more customers, and H&R Block also reaffirmed its outlook for the year. The shares initially rose in after hours, but finished the regular day down 3 cents to $25.77. Up next, the big happenings going on with big oil. And here's a look at what to watch for tomorrow. The Federal Reserve releases its Beige Book. That's an anecdotal look at economic conditions across the country. We'll get new data showing where the U.S. trade deficit stands. And ADP is out with its latest employment report for the private sector. That comes just ahead of the big jobs report, which is due out later this week. And that is what to watch for on Wednesday. New orders for U.S.-made goods recorded their biggest decline in 6 months in the month of January. According to the Commerce Department, business spending on equipment also appears to be slowing after a string of strong growth last year. Well, the biggest names in the energy industry say demand is picking up, but their enthusiasm remains somewhat tempered because of all the turbulence that sector faced not so long ago. Brian Sullivan is in Houston at CERAWeek, one of the biggest gatherings of oil executives and officials.
Optimistic yet cautious. Those words describe the mood at one of the world's biggest oil, gas, and energy conferences. After a boom and then a terrible bust, all within the last 10 years, the price of oil has remained relatively stable lately, and the industry is once again talking about growth.
What we are seeing is healthy economic growth globally, healthy demand that we are seeing and forecasting going forward. The economy is doing very well, not only in OECD country, in the rest of the world, and with that there will be a healthy demand. That is our projection.
But officials caution there is a new threat to that optimism, a lack of new capital coming into the global energy markets. The head of OPEC warns that unless major new investments are made soon, production growth rates could actually drop. And with demand growing, the world could once again face a new kind of energy crisis.
If the trend of the last 2-3 years continue, and God forbid, we will be sowing seeds for future global energy crisis that nobody wants to see.
With global economies on the rise and stock markets everywhere doing fairly well, the lack of new investment can seem perplexing. But an investment banking executive says that investors are simply worried about being burned again.
Part of it is because the stocks have done badly through the downturn. So, people are sort of, affected by the fact that we had a difficult period just driven by lower oil prices. And we've had another phenomena, which is natural gas prices, which is very important to the U.S. sector, have marched down over the last decade pretty solidly.
Most experts agree that any major production issues are years away. But in an industry where projects can cost tens of billions of dollars and take years to develop, they want to lay the groundwork now for future investment later. For Nightly Business Report, I'm Brian Sullivan, Houston.
There is a new billionaire that is richer than all others, according to Forbes' latest annual list. In the top spot, Amazon's Jeff Bezos. He is the first centibillionaire with a net worth of $112 billion. Microsoft founder Bill Gates fell one spot to number 2 with $90 billion. Rounding out the top 3, Berkshire Hathaway's Warren Buffett at $84 billion. There are 2,200 billionaires around the world. They hold a combined net worth of more than $9 trillion. Before we go, here's another look at how the major averages finished the day. The Dow finished just 9 points higher to 24,884. The Nasdaq was up 41, and the S&P 500 added 7. Keep an eye on how the market reacts to the late evening report that the president's economic advisor, Gary Cohn, is resigning. That will do it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us. We want to remind you this is the time of year your public television station seeks your support, and we thank you for it. Have a great evening. See you tomorrow.